Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
Today is Tuesday, February 3rd, 2026. And if you were watching the ticker tape today, you really saw one thing dominating the screen. Palantir Technologies, it closed at $155.43. I mean, we are talking about a 5.19% jump in a single trading session. The volume was just massive, over 42 million shares changed hands. We saw a daily high of exactly 165. And we have to talk about why these numbers are just flashing so green.
We absolutely do, because this isn't just some random Tuesday pop. This is the aftermath, or maybe the aftershock of the Q4 earnings they released yesterday, February 2nd. And frankly, if you look at the chart, this is a rescue mission. January was absolutely brutal for this stock. It had lost, nearly 30% from its highs. It slipped below the 200-day moving average. I mean, the market was bracing for a complete disaster.
And instead, they got a rocket ship. But that brings us, immediately to the central question. The numbers were good, sure, but were they that good?
Exactly. We're looking at a market cap hovering around $352 billion. So the tension here isn't about whether the software works. We know it works. The question is whether Palantir has successfully pivoted from this, secretive government contractor to the definitive AI operating system for the entire modern enterprise, or if this market is just caught in a price-to-prophecy hysteria. Are investors paying for a perfect future that hasn't actually happened yet?
I see why you'd frame it as hysteria, given the volatility. I know, the chart looks vertical. But let me give you a different perspective. I believe what we are witnessing is a fundamental decoupling of Palantir from traditional software dynamics. For years, analysts looked at this company and tried to fit it into a box. Is it a consultancy? Is it a SaaS company? What the recent report confirms is it's something different. It's the industrialization of intelligence.
That's a very catchy phrase from the earnings call, but we need to ground that in the math.
The math is exactly where I'm going. Look at the 2026 guidance they provided yesterday. They're forecasting revenue of $7.18 billion to $7.2 billion. But the number that really matters, the one that signals this decoupling I'm talking about, is the Rule of 40.
Right. And for our listeners who might not live in spreadsheets, that's just the revenue growth rate plus the profit margin.
Right. In the software world, if you hit 40%, you get an A. You're an elite company. Palantir just posted a Rule of 40 score of roughly 127%. I mean, that isn't an A. That is breaking the curve. That is just unheard of at this scale. It tells me they aren't just selling software licenses. They're capitalizing on a structural shift in the economy. My core thesis is that Palantir has become the primary infrastructure layer for this whole agentic AI era. They aren't just riding the wave, they are building the surfboard.
Okay, I love the surfboard analogy, and 127% is an incredible metric, I will grant you that. But let's look at the price tag on that surfboard, because as an investor, you don't just buy the company, you buy the stock at a specific price. We are staring at a trailing PE ratio of approximately 345.
Which is high, I admit.
High? It's astronomical. I mean, even if we look forward, giving them all the credit for the growth you just mentioned, the forward PE is sitting somewhere between 140 and 180, depending on whose estimates you trust. That is priced for perfection. That assumes a generational shift where absolutely nothing goes wrong. If Alex Karp sneezes during an earnings call, the stock could drop 20%. At a $352 billion market cap, this looks less like a sound investment and more like a high-risk gamble on a narrative that's just becoming increasingly expensive to buy into.
Well, that's a fair critique of the multiples because you view them as a standard software company. But you have to understand how they're making money to understand why that premium exists. This isn't a Salesforce where you just add another user seat. It's a dual-engine model. You have the government side Gotham, which is, the bedrock. But the explosion, the reason we are seeing that 127% efficiency score is coming from the commercial side with the new growth engine, AIP, the artificial intelligence platform. The market is realizing that Palantir has a technical moat that nobody else has. They call it the ontology.
Let's just pause there for a second. Ontology. This word gets thrown around constantly on their earnings calls, and I don't think 90% of the people buying the stock actually know what it means. It sounds like philosophy, not software.
It does, but it's actually the most tangible part of their business. Let me break it down because this is really the aha moment. So most companies right now are buying large language models, LLMs. They get ChatGPT or Claude and they type in, how can we cut costs?
And the LLM just gives a generic answer based on text it scraped from the internet?
Exactly. It hallucinates. It guesses. Palantir does something different. They build a digital twin of the organization. The ontology defines the specific nouns of that business. It knows what factory A is. It knows conveyor belt B. It knows truck C. And then it defines the verbs, fulfill order, repair sensor, reroute truck.
Okay, so it's not just predicting text, it's mapping the physical reality of the business.
Precisely, because the system understands the semantic relationship between these things. That's the ontology. It prevents the whole garbage in, garbage out problem. So let's say a sensor breaks in a factory. An LLM might say, you should probably fix the sensor. Palantir's AIP, using the ontology, will say, sensor A failed. I have automatically ordered a replacement from supplier B because they are cheapest, and I have rerouted production to factory C to maintain output. It doesn't just chat, it executes. That is the industrialization of intelligence. It's an orchestration layer that sits above the compute.
I understand the technical architecture, and I agree that is much more sophisticated than a chatbot. But my concern is the scalability of that model. I mean, building a digital twin sounds heavy. It sounds like it requires massive implementation time. Is this truly scalable software, or is it just high-tech consulting disguised as a platform?
That was the old argument. Palantir is just a services company, but the data from 2024 and 2025 it's effectively killed that bear case. The shift to AIP boot camps completely changed the unit economics. These boot camps let customers go from zero to a functional use case in hours or days, not months.
And what does that do to the bottom line?
It collapses the sales cycle. The financial impact is right there in the report. The customer acquisition cost, or CAC, payback period has dropped to just 8.9 months. That is a benchmark for efficiency. And if you look at the 2026 guidance, they're projecting U.S. commercial revenue growth of greater than 115%. You simply do not get triple-digit growth in commercial revenue if your product requires an army of consultants to install. That's viral adoption.
Okay, I see the adoption numbers, and 115% growth is undeniable. But I come at it from a different angle when I look at the competitive landscape and the valuation relative to its peers. You talk about industrialization, but let's look at the industrialization of the stock price. Palantir is up 166% in the last 12 months. Now, let's compare that to peers. Snowflake is up 45%, Datadog 25%, C3.ai is down 60%.
I would argue C3 isn't really a peer, but go on.
Fair enough. But look at the multiples. Palantir is trading at roughly 67 to 93 times forward sales, not earnings, sales. Snowflake is trading at 14 to 20 times. Salesforce is at 7. You are paying a premium that suggests Palantir is in an N of 1 category, that they have absolutely no competitors. And that is a dangerous mindset for an investor.
But isn't it an N of 1 category? Is it? If Microsoft decides to offer a good enough version of this orchestration layer inside Azure for free, or if OpenAI builds agentic workflows directly into their model, that 93 times multiple just collapses. You're betting that the ontology is some kind of magic that cannot be replicated. I'm betting it's a moat that cannot be easily crossed. You compared them to Salesforce and Snowflake. But Salesforce is a database of customer names, a CRM. Snowflake is a data lake. It's a storage locker. Palantir is the brain that sits on top of Snowflake. That is why you see the massive institutions piling in. JP Morgan Chase didn't just buy a little. They more than doubled their position in late 2025. You have S&P 500 inclusion driving passive buying. The IVV ETF saw a 63% increase in its Palantir value. The smart money, the institutional money, is voting with its wallet that this is not just another SaaS company.
I'm sorry, but I just don't buy the smart money argument when the smartest money, the people running the company, are selling. We have to talk about the insider action.
I had a feeling we would get here.
We have to. The CEO, Alex Karp, sold nearly $2 billion worth of shares throughout 2024 and 2025. In just the last 90 days, ending January 29, 2026, insiders sold over $167 million in stock. If we are entering the golden age of AI, and if Palantir is the central nervous system of the West, why is the leadership cashing out so aggressively?
I think you're over-indexing on standard diversification. Alex Karp has been at this for over 20 years. For 2 decades, his wealth was entirely tied up in this one company. Selling shares to diversify is just standard practice for founders. He still retains millions of shares. His incentives are very much aligned with the company's long-term success.
It's not just the selling, though. It's the governance. We cannot decouple the stock from the man himself. Alex Karp is, let's just call him eccentric. He calls himself an arrogant prick. He owns 20 homes he describes as ski huts and travels with a coterie of bodyguards. But what concerns me more as an investor is the Class F share structure.
The founder shares.
Yes. The founders control roughly 465 to 1,250 votes per share. Investors have absolutely zero say. You can't fire him. You can't vote for a new direction. You are handing your capital to a philosopher king and just hoping he remains benevolent. That is a governance risk that I think the market is completely ignoring because the line on the chart is going up.
I would argue that in this specific geopolitical climate, you want a philosopher king who isn't swayed by short-term activist investors. Look at the catalysts. We aren't just selling software to banks. We are talking about landmark government awards that prove stability. In July 2025, they secured a $10 billion contract with the U.S. Army. They have the $448 million shippost contract with the U.S. Navy. The Maven Smart System funding was increased by $795 million.
Those are impressive wins.
They are 10-year commitments from the most powerful entities on Earth. And on the commercial side, they're allying with NVIDIA for energy grids and Oracle for data centers. They are embedding themselves into the critical infrastructure of the West. That stability commands a premium. Karp's arrogance, if you want to call it that, is justified by results. He has delivered 12 consecutive revenue beats and 1,700% returns in 3 years.
Stability is one thing, invincibility is another. The risk profile here is significant. RBC Capital has maintained a $50 price target. If they are right, that's a potential 60% drop from today's close. And we haven't even touched on the geopolitical and ethical risks. Their work with ICE on immigration enforcement and their involvement in active battlefields like Ukraine and Israel makes them a massive political target.
Or a strategic asset.
Perhaps both, but purely on a technical level, the competition isn't standing still. Can Microsoft or OpenAI replicate that orchestration layer? Can they do it cheaper? Palantir is betting they can't. But if Microsoft offers good enough orchestration, the value proposition weakens.
And that brings us to the sticky nature of the ontology. Once an organization builds its digital twin in Palantir, ripping it out is nearly impossible because it powers daily operations. It's not just an analytics dashboard you can turn off. But let's make this tangible for our listeners. Let's talk about the profit potential. Let's say someone is listening to this and thinks, okay, I've got $5,000 to invest. Do I buy Palantir at $155?
Right, and that gets you roughly 33 shares today. And if you buy now, you better have a strong stomach.
Why?
Because in the short term, volatility is the main character. If the bull case plays out and the stock hits the high targets of, say, 255 to 267 in the next 12 months, that $5,000 investment grows to about $8,500. That's a 70% gain. Amazing. However, if valuation fatigue sets in, and it happens to every high flyer eventually, we could retreat to the 52-week low of $66. That's not impossible given the beta of 2.1. In that scenario, your investment drops to about $2,200. That's a 56% loss. That is the definition of a high-risk entry point.
I focus more on the mid to long term. If we look out 3 years to 2028 or 2029, forecasts suggest annual revenue growth of 25 to 30%. A target price of roughly $244 turns that $5,000 into $8,141. That's a 62% return.
But the real story, the one I subscribe to, is the winner-take-all scenario in 2030.
And this is where the numbers get truly wild.
They do, but they follow the logic of the industrialization of intelligence. The baseline case for 2030 puts the target at $288, nearly doubling your money to about $9,600. But there is a $2 trillion bull case. If Palantir rivals Oracle's ubiquity and market cap, if they truly become the operating system for the West, the price could hit $875 per share.
And the payoff?
That $5,000 investment would be worth $29,137. That's a nearly 500% gain. You do not get that potential upside buying safe utility stocks.
And you don't get the downside risk either. We have to mention the intrinsic value. Discounted cash flow models, which strip away the hype and just look at cash generation, suggest a fair value closer than $95. That implies the stock is currently expensive and that the $155 price tag already embeds very optimistic outcomes. If the PE compresses to a normal software multiple of, say, 65, the price could stay flat for 3 years, even if the company grows revenue by 30% a year. That is the danger of buying at the top of the hype cycle. You can be right about the company and wrong about the stock.
I see that risk, but I view it as the price of admission for owning the future. To summarize my position, Palantir has effectively become the central nervous system of the Western world. The ontology is a unique moat that prevents competitors from easily displacing them. The guidance for 2026, specifically that 60% plus growth metric when you combine revenue and margin, justifies the premium. We are seeing the industrialization of AI, and Palantir is the factory floor.
And my summary is this. It's a great company, but at terrifying price. The margin of safety is non-existent at these levels. The bet requires flawless execution, year after year, and total trust in a polarizing CEO who is actively selling his own shares. While the technology is impressive, investing at $155 requires you to believe that nothing can go wrong in a world that is increasingly defined by things going wrong.
Ultimately, investing in Palantir right now is a bet on a paradigm shift, not just a software company. Investors have to decide if they're buying a meme stock or, as Carr puts it, the future of sovereignty.
A decision that likely requires a strong stomach, regardless of which side of the trade you take. There is certainly more to explore in these numbers as the year unfolds.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.